Today is a class on accounting ratios. Accounting ratios part 2 plus 2 part 2. Accounting ratios or a ratio is a mathematical number calculated as a reference to relationship between two or more numbers and can be expressed as a fraction, proportion, percentage and a number of times. Ratio is a mathematical number. It's a number. How is it calculated? How ratio is calculated? It shows the relationship between two numbers. A ratio shows the relationship between two numbers and is either expressed, the relationship may be either be expressed as a fraction, proportion 1/2, proportion 1:2, percentage and a number of times. A number of ways we can express the ratios. When the number is calculated with reference to the accounting numbers derived from the financial statements, if we are calculating the ratio from the accounting numbers from the accounts, which is shown in the financial statements, that is either from the balance sheet, profit and loss account or any other financial statements, it is termed as accounting ratios. The textbook I am showing is the NCERT textbook. Okay. Then there are mainly 4 types of ratios. The first one is liquidity ratios, solvency, second one solvency ratios, activity or turnover ratios, and the last one is profitability ratios. First we can move on to the liquidity ratios. Liquidity ratios shows the ability of the firm to pay the amount due to the stakeholders. Stakeholders are those persons who are interested in our company or in our business, like creditors, bankers, investors, etc. within a short period of time. The main thing is the liquid amount or the amount due to these stakeholders. The business, if the business firm or the company pays within a short period of time, that the ratios used for calculating the short-term solvency or the ability of the company or a firm to meet its short-term obligations due to the creditors due to the shareholders is known as liquidity ratios. Solvency ratios. Solvency ratios, if the shows the obligation of the business firm or the company to pay the amount due to its shareholders or the stakeholders in a long period of time, it is known as solvency ratios. Then the third one is activity ratios or turnover ratios. This ratio measures the efficiency of the operations of the business. How much our firm is efficient, that is measured using the activity or turnover ratios. It is also known as, this ratio is also known as efficiency ratios. The fourth one is profitability ratios. Profitability ratios shows an analysis of the profits in relation to the revenues or from the operations. It shows the profitability in relation to certain figures from the operations. Then the first ratio, we can move on to the first category ratios, liquidity ratios. In liquidity ratios, we have to study about only 2 category of ratios, that is current ratio and quick ratio. Current ratio shows the relationship between the current assets and current liabilities, and of course the equation is current assets divided by current liabilities. I will show one problem regarding to the current ratio so that you can easily understand it. Like in this problem, we have to calculate the current ratio. Then the items that are given is inventories. Inventories means stock. Trade receivables. Trade receivables consist of debtors and bills receivables, advance tax, cash and cash equivalents. Then trade payments. Trade payables. Trade payables consist of creditors and bills payable. Short-term borrowings. It's bank overdraft. So we have to calculate the current ratio. So first of all, we have written the equation, that is current ratio is equal to current assets divided by current liabilities. And how we calculate the current asset? Current assets, what are the current assets will come? Current assets include current investments. Current investments comprised of investments that are kept only within 1 year or that are kept in the firm for only 1 year. Then inventories, stock, trade receivables consist of debtors and bills receivable, cash and cash equivalents, that is equal to cash items, short-term loans and any other advances. And also it includes current assets such as prepaid expenses, advance tax and accrued income. Accrued income means income earned but not received. The current liabilities include short-term borrowings, trade payables that include creditors and bills payable, and also other current liabilities and short-term provisions. Provisions are amount that kept in the business to meet the loss occurred due to the business firm. If the provision is kept for short period of time, that is known as short-term provision. So come to the question. We have written the equation, then current asset is equal to, we have to write what are the current assets: inventories, trade receivable, advance tax, then cash and cash equivalents. Only this much items comes under current asset. Then we have to write all the amounts relating to the figures. Then the total will be 1,34,000. Then come the current liabilities. Current liabilities only two current liabilities: trade payables and short-term borrowings. The amount is 1 lakh plus 4,000, 1,04,000. Then coming into the equation, that is current assets by current liabilities. Here what is amount of current asset? 1,34,000 divided by 1,04,000. And by doing this, we cut the zeros. First of all, we cut the zeros, and when we divide the 134 divided by 104, we can get the answer as 1.29. Since it is relationship between two figures, we have to write the answer as to 1.29 is to 1. That is, current liabilities is recorded as 1 and current ratio is 1.29 is to 1. Since it has to be written in a ratio form, we write it as 1.29 is to 1. Then comes the quick ratio. Quick ratio implies the ratios which can be calculated in a, or the very short-term solvency. It shows the measurement of the very short-term solvency of the business. It is also known as liquid ratio or the acid test ratio. The equation is quick assets divided by current liabilities, or quick assets is to current liabilities. Quick assets are defined as those assets which are quickly converted into cash. So while calculating the quick assets, we exclude from the current assets items such as prepaid expenses, advance tax, prepaid expenses, advance tax, and also the inventories. So quick assets means the assets that are quickly converted into cash. So here comes the problem. Quick ratio. We have to calculate the quick ratio. That problem is from the previous question, and we have calculated the current liabilities. Then we have to calculate the quick assets. Quick assets is equal to, what's the equation? Current assets minus inventory and what? Advance tax. There is no prepaid expenses in this question. So we get the amount. First of all we add the inventories and advance tax, then reduce it from the current assets amount. So we get the amount as 80,000. Current liabilities we have already calculated 1,04,000. Then when we divided it, quick assets divided by current liabilities, we get the amount as 0.77. Since it has to be written as in a ratio form, we write it as 0.77:1. Thank you.